Treasury yields held steady after Brainard said fighting inflation was the Fed's most important task this year. Yields for U.S. government debt barely budged Thursday afternoon following testimony by Federal Reserve Governor Lael Brainard, who said that lowering inflation will be the central bank's most important task for the foreseeable future. Data released earlier in the day showed U.S. weekly jobless claims jumped to the highest since mid-November, while U.S. wholesale prices rose just 0.2% last month, but have risen 9.7% in the past year. Meanwhile, the spread between 2- and 10-year yields shrunk to 82 basis points, while the gap between 5- and 30-year yields narrowed to 58 basis points. What are yields doing? The 10-year Treasury note almost 10Y, 1.725% yields 1.723%. Compared with 1.724% on Wednesday at 3 p.m. Eastern Time. Yields for debt fall as prices rise. The 2-year Treasury note almost 02Y, 0.894% rate was at 0.895%. Versus 0.905% a day ago. Wednesday's level was the highest since the 27th of February 2020. The 30-year Treasury bond almost 30Y, 2.074% yields 2.068%. Versus 2.071% on Wednesday afternoon. What's driving the market? Yields across maturities have risen sharply to start the year as investors brace for a period of higher than usual inflation and a Federal Reserve that wants to tighten monetary policy to combat it. During a confirmation hearing to take the central bank's number 2 spot, Brainard said inflation is too high, and working people around the country are concerned about how far their paychecks will go. Our monetary policy is focused on getting inflation back down to 2% while sustaining a recovery that includes everyone, she said. Read, Lael Brainard says inflation is too high. The Fed will work to bring it down. Some analysts are starting to wager that yields will end 2022 substantially higher, with the 10-year touching 2%. Particularly if pricing pressures require more than the 3 benchmark interest rate increases that market-based projections are showing. On Wednesday, St. Louis Fed President James Bullard said that 4 interest rate rises were likely this year. FactSet data released Thursday showed U.S. wholesale prices rose a scant 0.2% in December, to mark the smallest increase in 13 months. The increase in the producer price index fell below the 0.4% forecast of economists polled by the Wall Street Journal. Meanwhile, the advance in wholesale prices over the past year slipped to 9.7% from 9.8% in the prior month. It was the first decline in the yearly rate since early in the pandemic. The PPI report came a day after the consumer price index for December showed the headline, year-over-year inflation rate rose to an almost 40-year high of 7%. Indicating higher prices are likely to persist into 2022. Meanwhile, initial jobless claims rose by 23,000 to 230,000 for the week ended January the 8th, the highest since mid-November. Economists polled by the Wall Street Journal had estimated new claims would slip to 200,000. Though jobless claims were higher than estimates, they still pointed to a tight jobs market. Looking ahead, investors will watch for an auction of $22 billion in 30-year bonds at 1 p.m. Eastern Time that could influence Treasury trading. What analysts are saying: even though PPI rose by less than expected, we believe investors have reason to remain hyper-focused on factors likely to keep inflation elevated in the months ahead, said AXS Investments Chief Executive Greg Bassick. Although consumer price data briefly satisfied investor hopes on Wednesday that inflationary pressures might become more tenable, we caution investors that 1 month's data is not a market cycle, and a premature conclusion on inflation's trajectory based on 1 month's reading could lead to misalignment in investor portfolios, Bassick wrote in an email.